Taxing unrealized capital gains is a topic that has been gaining a lot of steam here, especially recently. Basically, people have figured out how to avoid paying taxes on their investments, and some government officials simply cannot take it anymore. Basically, they feel like certain individuals should pay taxes on their assets that rise in value even though they have not sold the investments. So then why does the government want to do this? Well, as a licensed CPA, let me paint the picture for you. So let's say you have a lot of assets like real estate, stocks, bonds, and so on that have appreciated in value. Now, if you sell these assets for a profit, you will pay tax on that profit. No questions asked. But if you never sell those assets, you will never pay tax on it under the current system. So even if your assets grow to millions, hundreds of millions, or even billions of dollars in wealth, as long as you do not sell those assets, you will never pay tax on it. So then what's the problem? Well, the problem is that certain wealthy individuals have figured out a way to never pay taxes on the wealth they accumulate. Now, usually when someone needs money, they might sell some of their assets, like their home or some stocks, to pay for the things they need or want. But for many wealthy individuals, instead of selling their assets and triggering a tax, they simply borrow against their assets. And when you borrow against your assets, the proceeds are not treated as income, essentially allowing them to liquidate their holdings without triggering a taxable event. Now, to be fair, you do not have to be wealthy or have a certain amount of money to do this. Technically, anyone with assets can do this. For example, you could borrow against your home with a HELOC or home equity line of credit, or you could borrow against your stocks or bond portfolio with a SBLOC or securities-backed line of credit. Now, technically, this is called the buy, borrow, die tax strategy. And I have a full video on our channel that breaks this entire strategy down for those who want to learn more about it or even take advantage of it. But right now, there are pending tax proposals that may completely change how investments will be taxed in the future. So let's talk about those proposals and, more importantly, how they could affect almost every taxpayer watching this. Okay, so if you don't know what an unrealized capital gain is, it's basically when you buy an asset and that asset appreciates in value. For example, if you purchased a home for $100,000 20 years ago, and it is now worth $300,000, you would have $200,000 in unrealized capital gains. Or if you bought $200,000 worth of stocks over many years and it grew to $1 million in wealth, you would have $800,000 in unrealized gains. Therefore, if you own any asset, even a business, that is worth more today than what you paid for it, then you have an unrealized capital gain. And as of right now, there is no tax on these types of gains. But also as of right now, there are proposals to start taxing unrealized capital gains. President Biden and Kamala Harris have both supported the idea of taxing unrealized capital gains. And by the way, I know this topic is hot, but this idea is not new at all. There have been proposals on taxing unrealized gains that go back to the 1960s and 70s. It just never happened. But if this bill was passed, it will completely change the trajectory of the tax code as we know it. But before I explain how, let's talk about what exactly they are proposing. So under their proposal, taxpayers with over $100 million in net wealth would be required to pay a minimum of 25% on their unrealized capital gains if their effective income tax is less than 25%. Now, I'm going to explain in a second how this tax could still affect most taxpayers, but first let's walk through an example to show you how this new tax would work. Okay, so when I did the math on this, someone who ends up paying this tax could easily pay over 75% of their earned income towards taxes in a single year, which completely surprised me. So let's pretend we're worth $200 million and walk through a very simple example. So let's pretend you have $5 million in ordinary income and you pay $1.8 million of that towards taxes, making your effective tax rate about 35%. But now let's say you have $10 million of unrealized capital gains. This proposal would include this as part of your income, making your total income $15 million instead of $5 million. And then it would impose a minimum tax of 25% of that total dollar amount, which equates to a minimum tax of $3.75 million. So instead of paying $1.8 million in taxes under the current system, your taxes would more than double to $3.7 million. And what's scary about this scenario is that we still have the same $5 million in earned income. We didn't make any more money, except now 75% of that income is going towards taxes simply because of your net worth. So regardless of your income, just think about a system where 75% of every dollar you earn is going to the government and how that might make you feel. Would you be motivated to create new businesses, create new jobs, and spur innovation in a world where you are left with 25% on every dollar that you earn? Skeptics of this tax proposal think that it could have a negative impact on the economy. And some would even go as far as to say that it could crash financial markets if wealthy individuals start panic selling and liquidating their assets. But outside of that, I know there is someone watching this that is saying to themselves, well, this tax does not apply to me, so who cares if the rich is going to pay more taxes? However, that might be a short-sighted view when you consider how the tax code typically works over time. For example, in 1913, the maximum income tax rate was just 7%, and then that jumped to 15% in 1916, which then jumped to 67% and eventually up to 94% in 1944. Now, in the same sense, we've seen tax rates work their way down as well, but my point here is simple. Tax changes compound over time. It's like a snowball effect. We've seen individual tax rates, capital gains tax rates, corporate tax rates, and so on change dramatically based on who is in office. And if this proposal is passed, it would represent a completely new type of tax, and there is no telling how the tax would apply to taxpayers or change in the future. They could increase this tax, decrease this tax, or start assessing the tax on people with lower levels of income and wealth. So the real question is, do you agree or disagree with a wealth tax? Would you personally be okay with paying tax on assets that you have not personally sold? Just let me know what you think in the comments below. And if you happen to have a high tax bill and you need help with that, just go to mycpacoach.com to apply to work with one of my CPAs today.